Hello, welcome to the weekly podcast of Succinct, an information source that helps you save time while keeping you well informed of key events, catalysts, and performance of capital markets. This brief is professional and free of noise. If you are looking for the classic journalistic, future guessing, and tips from self-proclaimed gurus, you can switch off now. These are the highlights from last week.
Global market sentiment turned negative after strong data and higher inflation readings in the US surprised analysts. The key update took place on Friday when PCE inflation for January, the Fed's preferred measure of inflation, came in higher than expected and above that of December. PCE, or personal consumption expenditures, increased by 0.6% compared to 0.2% in December. The annual figure was 5.4%, marginally higher than in December. Core PCE, which excludes the volatile items of food and energy, also rose by 0.6% month-on-month, and 4.7% year-on-year. This data show a reversal of the recent disinflation trend that led the Fed to slow the pace of its tightening cycle a month ago. Data in the US also reflect a robust economy, with personal consumption growing by 1.8% in January. This adds to the strong retail sales update of a week ago, and the solid employment report for January, released at the beginning of February. All these support a scenario of a more hawkish Fed, as reflected by the futures markets. The market is now pricing in the Fed funds rate to peak at 5.4% in September, from the current 4.625%. The probability of a 50 basis point hike in the next Fed meeting on March 22 doubled from a week ago to more than 20%. Until very recently, the chances for a smaller, 25 basis points hike, were above 90%. So, where does all this leave us? Positive news for the economy and accelerating inflation supports the recent message from Fed Chair Powell, who said that the FOMC will remain data dependent. And that only means higher interest rates for longer. What was the market's reaction? Well, risk assets sold off, with the S&P 500 index losing 2.7% to 3,970 points, reducing its year-to-date gains to 3.4%. The Nasdaq Composite fell 3.3%, and is now 9% higher in 2023. European stock indexes fell 1.5% on average last week, while developed Asian markets ended modestly lower. The dollar jumped against all other major currencies, and the DXY dollar index added 1.3% to 105.2 points. The euro is trading at 1.05, and cable at 1.19. Both are down around 1.3% this year. Unsurprisingly, bond markets sold off, with short-end yields climbing. 1 to 2 year government notes, the most sensitive to monetary policy, fell across markets. In the US, the yield on 2-year notes jumped 18 basis to 4.81%, the highest close since 2007. The US yield curve shows the steepest inversion in more than 40 years, at minus 86 basis points, for the spread between the 10 and 2-year bonds. The 10-year Treasury now yields 3.95%. German Bunds are at 2.53%, and British gilts at 3.66%, all between 7 and 12 basis higher this year. On the commodities front, exactly 1 year after the Russian invasion of Ukraine, most sectors are trading well below their pre-conflict levels. For example, in base metals, a key Russian export, aluminium fell nearly 30% since the invasion, and copper is down by 11%. By the way, on Friday, Washington imposed a 200% tariff on aluminium imports from Russia. On the energy complex, European natural gas prices dropped 27% in the past year, and the US benchmark plunged 42%. Crude oil prices also fell after their initial spike last February. Front-month contracts for WTI are now trading at $76, against $91 just before the invasion. Brent is at $83, 15% lower than a year ago. Let's finish with a quick note on emerging markets. Stocks in Hong Kong, Brazil and South Africa were the underperformers of the week, with benchmark indexes losing more than 3%. On currency markets, the notable mover was the Chilean peso, down 4.6% to 826, its worst week in 3 months. In the past 4 weeks, the Russian ruble depreciated 8.5% to 76. That's all for today. Don't forget to subscribe and hit the notification bell so you don't miss our weekly updates. Please share the podcast with friends. Also, visit succinct.info to learn more about us. Have a great week.